250 times. That is not a typo, and it is not a percentage. That is the scale of the profit surge Samsung has just reported, and it is the single largest number on any trading desk this morning, Thursday the 30th of July, 2026. And yet here is the puzzle. Ether and XRP, two of the largest cryptocurrencies in the world, have barely moved. They are flat. Chip stocks are steady rather than euphoric. When one of the world's most important manufacturers posts a result on that scale, and the risk assets that normally dance to the semiconductor tune simply stand still, something structural is happening beneath the surface. In this video we will unpack what came through overnight, why the crypto market has shrugged, what it means for anyone holding digital assets or technology exposure in a British portfolio, and where the current evidence points next. Let us be precise about the arithmetic, because this is where most coverage goes wrong. A 250-fold increase in profit is not the same as a business becoming 250 times better. It is mathematically only possible when the comparison period was close to zero. Samsung's memory division spent a long stretch selling chips at or below cost as the industry worked through a brutal oversupply cycle. When your starting point is almost nothing, even a normal recovery produces an eye-watering multiple. So the honest reading is this: the surge confirms that the memory cycle has turned, and that high-bandwidth memory demand tied to artificial intelligence infrastructure is real and being paid for. What it does not confirm is that valuations across the sector have room to expand further. Professional investors understand that distinction instantly, which is precisely why the reaction in chip stocks has been steady rather than explosive. The news validates the recovery. It does not re-rate it. For most of the last cycle, there was a reliable pattern. Strong semiconductor earnings lifted the technology complex, that lifted the broad risk appetite, and crypto caught the updraft within hours. That transmission belt has visibly weakened. Ether and XRP sitting flat on a day like today is the clearest evidence yet. Part of the reason is who owns these assets now. Spot exchange traded products have brought in allocators who size crypto against fixed income and gold, not against Nvidia or Samsung. Their rebalancing is calendar-driven, not headline-driven. The other part is that a Korean memory result, however spectacular, says nothing about the things that actually move digital assets right now: regulatory clarity, network activity, staking flows and dollar liquidity. XRP in particular trades on legal and payments developments. Ether trades on network usage and staking economics. Neither is a proxy for chip demand anymore, and today's flat tape proves it. You cannot read today's muted reaction without remembering what happened earlier this month. On Sunday the 19th of July, 2026, Bitcoin was reported flat around the $64,000 level while oil pushed to a one-month high, and the sell-off triggered by the Kimi artificial intelligence story continued to weigh on sentiment. That episode did real damage to positioning. It reminded the market that the AI trade carries a specific and underappreciated risk, which is that a cheaper or more efficient model can arrive without warning and instantly change the arithmetic on how much computing hardware the world needs. Once traders have been caught by that, they stop buying every good chip headline with both hands. So Samsung's result lands in a market that has already learnt caution the hard way. The number is welcomed. It is simply not being extrapolated. That behavioral shift, more than any single data point, explains the flatness across both equities and crypto. There is a second force pinning risk assets in place, and it comes from the commodity market. Oil reaching a one-month high in mid-July matters far more to a British viewer than a Korean earnings release, because energy costs feed directly into the inflation numbers the Bank of England watches. Higher crude means higher transport and manufacturing input costs, which flows into headline inflation with a lag of roughly 2 to 3 months. If that pressure persists, the case for near-term rate cuts weakens considerably. And crypto, despite everything said about it being an inflation hedge, has consistently traded as a long-duration asset, meaning it performs best when rate expectations are falling. That is the crossfire Ether and XRP are sitting in today. Good news from the technology sector on one side, a stickier inflation and rates picture on the other. The net result is exactly what we are seeing on the screen, nothing. So how does this land practically? If you hold a global technology fund or a broad index tracker, you already own this Samsung story through your semiconductor weighting, and the steadiness of chip stocks today suggests that exposure is doing its job without demanding any action from you. If you hold Ether or XRP, the important insight is that your holding is now behaving as a genuinely separate asset class rather than a leveraged bet on the Nasdaq. That is arguably healthy for diversification, but it also means you should stop watching chip earnings as a signal for your crypto position, because the relationship is no longer reliable. For anyone sitting in cash and waiting for an entry, a flat market is not a dead market. It is a market where buyers and sellers are genuinely balanced, and those periods historically resolve sharply once a catalyst arrives, in either direction. Looking at the near term, 3 things will decide the next move. First, whether the rest of the memory and logic chip sector confirms Samsung's recovery in the coming reporting rounds. One company turning is a data point, and a sector turning is a trend. Second, whether oil holds its recent gains, because a sustained energy move would push rate cut expectations further out and cap any crypto rally before it starts. Third, whether flows into crypto exchange-traded products resume, since those flows have become the dominant marginal buyer for the large capitalization coins. Watch for a decisive break in either direction from these compressed ranges, because prolonged flatness compresses volatility, and compressed volatility historically precedes larger moves. The base case on current evidence is continued range trading in Ether and XRP, with chip equities grinding higher on genuine earnings delivery rather than on hopeful multiple expansion. Here's the thing to carry away from Thursday the 30th of July, 2026. The old story was simple: chips go up, crypto goes up. That story is over. Samsung has just delivered one of the most dramatic profit recoveries you will see in corporate reporting, and Ether and XRP responded with a collective shrug. Treat that as information, not as an anomaly. It tells you that digital assets are being priced on their own fundamentals now, and that the market has become disciplined enough to separate a base effect rebound from genuine new growth. If you take one practical step today, it is this: stop trading crypto off technology headlines, and start watching product flows, energy prices, and rate expectations instead. Those are the levers that are actually moving your position. Thank you for watching, and do subscribe for daily market breakdowns in plain English.